Are you ready for the golden key? That's what you're going to have at the end of this, the golden key. This is where you'll finally be able to bring home the cash you deserve. Oh my gosh, this is going to be great. I want to make sure that you have all your financials in front of you that we talked about, so you have those. And I go into all of this in great depth with my clients, but you're going to have everything you need to get started with this, which is going to be great. We're going to demystify your financials and your cash flow. That's the goal here. That is the goal. We're going to cover cash flow versus profit because they're two different things. We're going to cover your financials, your cash position, how to specifically do cash flow, how to improve it. That's pretty important. You're also going to get a detailed listing of all the line items that you should have and be tracking in your accounting system. When to do cash flow. We're going to talk about how budgeting is not a 4-letter word. I'm going to give you a quick little accountant test that I have all my clients do, so you can determine if your accountant is a right fit for you or not. And then I have to give you a quick disclaimer. I am not an accountant. I for sure am an expert on independent specialty retail profit, cash flow, and financials. I'm an expert at that. You will find no one that has looked at it as many financials as I have. That's for sure. Well, I can think of one other person, but that's about it. So for sure, ask your accountant for any tax planning information and tax advice. But I'm sharing with you my 30 years of retail experience, over 30 years of retail experience. But looking at financials of independent stores. But for other things, though, you'll for sure need to talk to your accountant. Okay. And cash may be king, but cash flow is queen. And she holds the golden key that opens that kingdom. Cash flow is absolutely critical. Absolutely critical. So let's dig in and talk about the difference between cash flow and profit. You see, cash flow is the money that just flows in and out of a store, right? It comes in the front door from your customers, and then you write a bunch of checks, and then it goes out the back door, to your landlord and all your vendors and everything. Profit is what's left over from sales after all the expenses have been deducted. That's just a quick, easy way of explaining it. But the difference between cash flow and profit is the difference between success and bankruptcy. They're bold words, but it's true. A store can be profitable and still go bankrupt from cash flow. That's absolutely true. A store can be profitable on paper. The financials can show it's profitable, but it can go bankrupt because it doesn't have enough cash flow to service the debt it has. In some situations, you can have a business like Google, for example. Google had so much cash flow because they had so many people investing in them, right? Because people were investing for the future. But boy, they were not profitable for quite a while. And what I find is that most retailers don't have the financial backing that Google had. The other thing about this, is that they for sure don't always match up, right? And that's the other really stressful thing. I can remember when I got it, I'm sure this has happened to you, where you've looked at those papers, those financial papers, and it does not match what your checking account says. It's like you're holding the checking account, or you're looking at the checking account statement online, and then you're holding your profit and loss online, and it's like, these numbers are not the same. Oh my gosh. I used to feel like they were sometimes belong to a totally different store. And that's exactly what we're talking about, the difference between profit and cash flow. Oh my gosh, you guys, I can remember as if it was yesterday, meeting with my accountant, and he said, so Kathy, I remember because Don was his name, and he said, so Kathy, there's good news and bad news. The good news is you made a profit. And I was like, we did? Huh, oh my gosh, I couldn't believe it. Yes, he did. He said, you did make a profit. The bad news is you owe taxes on it. I said, what? He says, yes, I can understand your concern because it sure doesn't look like you can pay any taxes. And he was exactly right. My cash flow was terrible. This was one of the times I was nearly going bankrupt. I mean, and you wouldn't have known my numbers were good. I had no cash flow. I wasn't prepared for it all. And that's really what started me on this mission of getting real about my own numbers and making because I had to figure this out. I was just feeling like an idiot. It got me started on this whole this mission about it. And then as I learned so much, I wanted to make sure that other people didn't have the same problem. So we're going to go over a few definitions and go over some basic things. And I know the vast majority of you know all these things, but it's worth revisiting because I want to make sure that we are all on the same page. And there's one thing I want to discuss right away, and that is that people often get very emotional about numbers. So I want to talk to you about the emotional side about financials. And what I find is that it comes from two places. It comes from either fear of the unknown. I mean, because I can remember so clearly when a vendor would call, and it was a vendor that we really wanted, and Esprit was the name of the brand. I don't know if you guys remember that, but they wanted us, and we wanted them, and we had to send them pictures and all this stuff, you know. And they're like, okay, great. So I'm talking to the guy on the phone, and I'm so excited because it's the big hot new brand, and we can't wait. And the guy says, okay, yeah, that'd be great. He says, so just send us your financials, and then we'll take a look at it, and then we'll go from there, okay? And I said, great. And he said, do you have any other questions? I can remember swallowing very hard. I said, no, I don't. Thanks very much. And I hung up the phone. Oh my gosh, but I had this sick feeling in my stomach because I didn't know exactly what that word financials meant. And I knew I should have known. I mean, and I was embarrassed to ask my accountant about it because I felt like every good business person should know what financials were. I can remember sitting in that chair and thinking to myself, you know, we were spending, my sister and I, it was our business together, and we were spending and generating hundreds and hundreds of thousands of dollars. Boy, doesn't that make me a good business person? I had 2 stores. Doesn't that make me a good business person? The answer to that question is no. Your sales volume has nothing to do with your financial knowledge. Nothing at all. I was right to feel nauseous. Jeez Louise, and that's when I knew I had to get an education like you are today. The other thing about numbers is that people often feel like they are their numbers. And you're not. And you're not. And listen, what I want you to hear is that everybody does this. We just started working with a new accountant, and I laughed as I heard myself saying things to him that I hear clients say to me. You know, like feeling like I had to explain any numbers that to me seemed like they might not have been entirely good or right or whatever, you know. And so, you know, it was just it's fear of judgment. That's the other thing. And I want you to know that there is no room for that because numbers are just black and white. That's all they are. If you love money, which you should, by the way, God wants you to love money because there's, you know, one of my mentors says, money isn't the most important thing, but it certainly touches everything that is. And really, for the most part, I think that that's true. And people can be motivated by money in different ways. Maybe it's not. I remember one woman who went through this process a while ago, and we were talking about her dream of what her perfect store was, and she came flat out and said that, yeah, that's just not motivating for me. I don't want to have $1 million store. I don't want to make, you know, $100,000. That's just not what I want to do. I was like, well, so what would you do? So let's just say you did have $1 million store, Mary, and let's just say that you did bring home $100,000. What would you want to do with it? She paused for a minute. There was this kind of long, uncomfortable silence on the call. It was during one of our community calls. And then she said, what I would want to do is I would want to give it to the missionaries who were at our church last Sunday because the work that they're doing is so important. And I just so wanted to be able to be a part of it. And I said, well, then that is why you want to make $100,000 and why you want to have $1 million business, because God doesn't give us all the same talents, you know. So she was not cut out to be a missionary, you know, and she said, right, no, you're absolutely right. She said, I'm cut out to be a toy store owner. I love that. And so I said, then what you want to do is be able to make money and use your talents so that you can then use the money to give away and help others and to create a legacy that way, right? Legacies can mean different things for different people. But it's important that you're looking at all this now and you're acknowledging all this now, because there is a lot of emotions around financials and around money. And you should love money because God wants you to be able to help others with it too, right? He does. And when you love money, then you've got to love the language of money, which is numbers. Numbers is the language of money. So that's what we're going over here. That is the point of all this. All right. So this is simply just black and white things. That's all it is. So remember that financials is simply a written report of the financial health of a store on one specific day. That is all it is. That's all it is. Just the financial health of a store on one day. It's just a snapshot. That's all it is. It includes your balance sheet and a profit and loss, which is also known as your income statement. And really, it's most valuable within context. What I mean by that is that there's always a story that when you get the before and after, you have a better story. Like if you were going to weigh yourself, that number just by itself doesn't account for the fact that you've lost weight or you've gained weight or you had Chinese last night and you're retaining water. I mean, it's not any of that, right? It just simply points to the fact that it's a snapshot of a picture in time. So your weight today really only matters if we know what your weight was yesterday or a month ago, right? And that's how accountants tend to look at things. They look at how things compared to previously. And accountants are really important because accountants want their clients to be more successful and more profitable for sure. And I'm so proud to say that all of our clients have been more profitable, brought home more cash every single year than the year before since 2008. Every single ongoing client. It's been incredible. I'm so proud of them. But let me tell you that the thing is that what accountants tend to do is that they tend to look back, whereas I look forward. I take the information from the past and use that information to carry it into the forward and tell you what specifically to do. So like if we had your weight for two things, and let's say that your weight had gone up, okay, from those two different, when I was saying it's most valuable in context. So if we had your weight from a month ago and your weight yesterday and your weight had gone up, the difference between what I do with clients and what we're going to talk about today and what accountants do is that accountant would say pretty much the equivalent of, okay, so lose weight. Good luck to you. Lose weight. I'll see you next month. We'll see how you're doing. Whereas what I would do is look at all that and then give you the tools that you specifically needed in order to lose weight to go forward. That's what we're going to talk about. So don't let the emotional side of numbers stop you from this, okay? So release the fear of the unknown. Release the fear of judgment. They just are what they are. They're just numbers, and they can always be changed. That's the beauty of it. They can always be changed. Okay, the next thing that we're going to look at is your balance sheet. So let's talk. So a balance sheet is literally the balance between what you owe and what you own. I said it the wrong way, didn't I? Between what you own and what you owe. So what I mean by that is that how most people understand this most clearly is in context of a house, right? So let's say your house was $300,000 and that your and that you owe $200,000 on it, and you own $100,000. Did I say that right? Yes. So your asset, which is the $300,000 of the value of the house, balances with your liabilities and your equity. And the liabilities is what you owe, so that's what you owe to the bank. So let's say you owe $200,000 plus $100, and that's what your equity is. So that's what balance sheet is. And let me give you a sample balance sheet because I want to be able to go over this because this is something that people don't do, and I want to make sure that you're clear on what should be here and what shouldn't. So hold on here. I just want to make sure that I have all my notes straight. Okay, so on the left-hand side, you'll see your assets. And again, remember when I told you that we have samples of all this, so you don't have to worry about it. No need to stress at all in any way, shape, or form because we have it all set for you. So on the left-hand side, you'll see your assets. And on the right-hand side, you'll see your liabilities. And it's the next page. Oh, so sorry. So here's your assets, and here's your liabilities, and here's your equity. Those are the three components of what your balance sheet is. Remember, I said that your assets are always going to equal what your liability and your equity is equal. The other important thing to know on this is what some of the other definitions are. So current, you'll see many places on here, and what current stands for is it's things usually short-term. So it means short-term assets versus long-term assets. That's what that usually means. So fixed means that they're long-term. So your computer system, your fixtures, that kind of stuff, that's what your fixed assets are, okay? Now the key points for retail, and this is the reason why it makes a big difference that this is what I do for a living, that all I do is look at financials like this, because this is where I can help you. So the key points for retail are, you should always see undeposited funds. You'll notice here that we didn't have it. This is actually an old balance sheet of mine. The name of my store was Duck Duck Goose. So this should have undeposited funds. What that means is that that's the money that's in transit. That's the money that the credit card, that you, from the sales that you made on the last day of the month, but you haven't gotten them from the credit card company yet. So that's what that means. The other thing that you want to make sure that's always on here, and that you have to always pay attention to, is your payroll liabilities and your sales tax payable. Let me tell you the difference between the two. So the payroll liabilities, this is when, you'll see this when you handle your own payroll, or that your company does, either yourself or your bookkeeper or whatever, or perhaps your accountant. And so this is where you're holding the money that you owe to the bank quarterly. Now, if you work with a payroll service, you won't see this number there because they hold the money for you. Just a way that they make a little bit extra cash on it. Okay, the sales tax payable. The mistake that I often see is that sales tax payable is often on the income statement, on the balance sheet. Excuse me, on the profit and loss, I mean to say. They often see it as an expense, but it's not. It belongs here. Because it's money that you're just holding until you give it to the government. You'll notice gift certificates up above. The same thing is true about gift certificates. It's the reason why those are here too, because gift certificates never count as sales. They always should be added or subtracted from the gift certificates outstanding, because again, you're just holding this money. These are all good examples of how in gift certificates you're holding that money for the clients, because the husband came in and bought a $200 gift certificate, but the wife hasn't used it yet. So you're just holding that money until the wife comes in to use it. So when the guy comes in and gives you $200 pays you $200 for the gift certificate, that's not a sale. That's a tender type, meaning it's no different than cash or check or credit cards. It's just a tender type because you're just hanging on to that money until it's used. When the sale is made and the gift certificate is redeemed, that is when you count it as a sale. And I know that's different from the way some of you do it. Don't hesitate to ask any other questions that you have about it. Payroll liabilities is the money that you're just holding for the government. And sales tax payable is the money that you're holding for your local state government. That's what that is. Alrighty. Now this is the other part of it that I promised to show you. So you can see here that this is where the equity is, right? And the key points for retail here is that retained earnings, what that shows us is all of the money that you have made in the life of the store. So at this point, we had made $62,164. All right? So that's since the beginning when the store was incorporated, that's the money it's made. Net income is how much you've made that year. That was the the income that year. All right, the next thing I want to talk about is your profit and loss, also known as a income statement. Not to be confusing, right? They talk about it that way because this is where your income is kept track of. But really what it is that simply how much came in from sales and how much went out for inventory and all the other expenses. And what's ever left over is the profit or loss. Sounds so easy, and yet it can get so complicated, right? So this now is a standard profit and loss. Let me go over some of the things here. So here we have what our income is. Here, often people will sometimes they'll track their internet sales separately. Sometimes they track returns separately. And here's their income sales. You'll notice that sales tax is not here because it should not be. Then the next section of a profit and loss is the cost of goods sold section. And that's this whole section here. I really believe that the only number that should be in cost of goods sold is your purchases. Just your purchases alone, that's it. Just your inventory purchases, because that's the number we can control. I really prefer that everything else be an expense. But there are accounting reasons why you don't look at it that way, and so that's why, as in my case, it is that way. But from an analytical standpoint, it's really important that you look at it that way. All righty. Then, the next thing I want you to look at is advertising. Because the one common mistake that I see made is that people don't look at advertising correctly. They tend to think of advertising simply as being the amount of money that they pay to advertise in papers or for Facebook ads or whatever. And that's just not true. It's everything that goes into advertising. Every single expense that you have had for an event, so let's say you do margaritas and markdowns, which is a fun event, by the way, or mimosas and markdowns if you want to do it first thing in the morning. That's a good preview party for a sale. If you're going to do either one of those things, the cost of the drinks has to go into advertising. So you can make subclasses underneath advertising if you want, but it all has to go into advertising. If you're mailing birthday cards out to people that have a discount in them, the postage of mailing those cards out does not go under postage. It goes under advertising because it's advertising. Okay? So that's why it's really important to know that all that stays together. Okay, travel. The one thing I wanted to tell you about travel is that travel should be separated out from meals and entertainment. That's just, you have your travel costs just separate by itself. That's really important too. So I want to make sure that you're looking at that. The next thing I want to make sure that you're looking at is the difference between shop supplies and store supplies. Oh, I'm so sorry. One more thing I want to say about travel is about car expenses, because I often see people not track their car expenses, and you really should. We'll talk about that later. But it's an easy expense or an easy deduction that people often miss is when you drive your car to the store and then you go someplace else and you're not tracking that, because you really should. All righty. So shop supplies or store supplies versus office supplies. This is critical. It always makes a huge difference, and you've got to track it separately. Okay, so shop supplies or store supplies is anything that you use for your store. So for example, if you're using, so it's your tags, it's your, what else is it? So it's store specific costs. So it's labeling things, it's your receipt paper. It's actually also your packaging. You can see here, and this is what I often see happen, is that packaging costs are separated out from your store supplies, but really they should be there together because, and I'll show you why later, but they should be together. So it's anything that you need to run a store. That's how you look at it. Then office supplies is anything you'd need to run an office. So like pens go in there, paper towels go in there, toilet paper goes in there, and all of those things. So that's the difference between store supplies and office supplies. And it's important that you track that separately. It's really important. Alrighty, like I said, I have samples of all this stuff, and any questions you have, I'm here. We're here to help. That's what we're here to do. Okay, the next thing we're going to talk about is something that nobody talks about. No one talks about this. And it's truly groundbreaking, and it's so important. So the point of knowing your cash position is to know where you're starting. And everything we've talked about always comes into all the rest of this knowledge. All the financials are used to generate the rest of the information. You need to know where you're starting to know where you're going, right? That's the point here. So we're going to start at the end of the last month. In this particular case, it's the end of a year, but it doesn't matter. It could be the end of whatever is the most recent cash position you have. It's really handy to do. And what this is telling you is that if you had to cash out of your store today, how would you cash out of it? One of the funny jokes that I often see is that if you look back at the balance sheet, you'll see that inventory is listed as a current asset, but it's not really so um, it's not really so current, is it? It's not as if it can automatically overnight be turned into cash, right? We all know that. And so that's one of the reasons why I put together this cash position, so that you could really look at, if you had to cash out of the business right now, what would happen? So this is in your worksheets, and I've given you the Excel spreadsheet to do this, and so just to make it as easy as possible for you, okay? So all of this comes from your balance sheet. So you can see there's line items on our balance sheets, those little green numbers. And so this is how this is going to relate then to the balance sheet numbers, okay? So we're going to go back and forth here. So assets, you see where that number 1 is? That's your bank account. That's the money that's in your bank account. And so that goes right there where it says bank account. Right here, right? All right, number 2 is AP trade. Now, AP stands for accounts payable. So this is how much you owe trade. So trade means your vendors. So this is your accounts payable trade. Now, some people separate it out. They'll have their bookkeepers or whatever separate out how much they owe for vendors and how much they owe everybody else. But this is just the term that's always used in the industry is AP trade and AP others. So I would say really the majority of people don't, but I separate it just in case. So let's take a look and see where we get that from. So that's, of course, under your liabilities, because remember, it's something you owe people. So down here is the accounts payable, $42,717. So that's then the amount that we're putting right here, $42,717. That comes from there. And there wasn't any other accounts payable, so that's where all that is. Now your payroll taxes, once again, remember that's money that you're holding for other people, for payroll taxes. So if you have it, it would be right here. Here's your payroll tax liability, right where it says number 4, 2505, right? 2505, right there, number 4. Okay, number 5 is sales tax due. Let me show you what that is. Right here, sales tax payable, and that's 4936. Which is right here, 4936. So this is all the cash you have, which is your bank balance, and then you're separating out, then you're subtracting out all the cash that you owe other people. So this 7898 minus all these numbers equals 42,260. Okay? Now number 6. Number 6 is how much you owe on your credit cards. So and that's right down here. Now actually what I really like to do is separate out the credit cards. Usually, and so actually really write out, so instead of just having a total here, I would write them out. I really prefer to do that. But in this particular case, we have it all together. So 22,945, and that's right here, 22,945, how much is owed total in the credit cards. And so then I'll often add that together so that we owe 42,260 plus we owe this much to credit cards. So it's a negative 65,205. And this is actually the number that we really use going forward. But I find, and then that Excel sheet I gave you, that it's also good to know. So here's number 7. Right here is your long-term liabilities. And that's your bank loan. I don't usually count loans to officers, but you certainly can. You can add in all of your long-term liabilities. Because it's good to see that number slowly go down, because that's what you'll see, right? But this is the number that we really focus on, is that cash position with credit cards. Okay, so then I would take this cash position with credit cards, that's negative 65,205, and I would add this to it, right? So it's negative 65,205 minus 47,952. And you're right, it's not 59,513. This is wrong. I was just checking. I was just testing you there. It's actually minus 113,000. So just keeping you on your toes, just keeping you honest there. So that's what this is. And so I wanted to make it simple for you so you could get all of the information from here, so you could see where all that information goes. Okay? Now, the next thing that we're going to go over, like I said, again, if you have any questions about all of this, don't hesitate to ask. But it's essential that we know where our cash position is, because like I said, this tells you where you're starting. So now we know what this number. Again, no judgment. I don't care what it is. All I care about is that it gets better, and that you owe less, that this number improves. That's what we care about. That's what we want to look at. So now we're ready to dig into your cash flow. So you're going to get a big glass of water. And you're going to look at your balance sheet, like I told you, from last year, your profit and loss from last year, your balance sheet dated the last day of the last month, if you can get that, as well as the profit and loss, same thing, from January 1st of this year until the last day of the last month this year. Then your last year's and this year's monthly sales. That's helpful. I want you to have that. As well as it can be handy to have your inventory level just to kind of look at too. I would recommend one calculator, maybe two, if you get frustrated and throw things sometimes. two pencils. Or honestly, all of this can be done on that Excel sheet also, obviously. And a good 16 ounces of water. Now, I have to tell you, I don't want you drinking anything else. But you can reward yourself afterwards, for sure. But this is what we get started with. All right, everybody? All right. So let's get into the cash flow directions, shall we? Now, the first thing I want to tell you is that there's a couple of general things I want you to be able to answer. I want you to know how your sales have trended with last year in order to determine how to forecast sales, and be conservative about that. I just have to tell you guys that this is where working with us one-on-one makes such a big difference, because we're able to forecast sales with 93% accuracy. 93% accuracy. It's crazy. And I've worked with these numbers, well, as a consultant for so long. And then when I had my own stores for 13 or 10 years, I guess it was. I didn't my first 3 years, but, and so it's really fabulous. But the most important thing to do is just to be conservative. I always say that I don't mind surprises. In fact, I kind of like surprises, but I hate bad number surprises. Can I get an amen? So then the next thing that you want to do is take a look at all of your expenses for last year, as well as your ones really, honestly, for this year too. Because you want to see if there's any one-time thing you did that shouldn't be included in the expenses. Things like, did you buy a new point of sale system? Or did you buy a new computer? But I want you to make sure that there's not a possibility of it happening again, because it's better to err on the side of overestimating your expenses, right? And then you can use that information to estimate your monthly expenses going forward. But yeah, it's really important that we are conservative about it. Like I'll talk to people about repairs and maintenance, and they'll be like, oh no, last year was just a really bad year. We had so many repair and maintenance that we have to do. So you can for sure decrease it for next year. Honestly, I'd rather use the same number just to have that margin, right? To have that little cushion is how I like to look at it. The other thing too that you want to look at are balance sheet expenses. Now, a balance sheet expense kind of sounds like a oxymoron, right? Because what the heck is a balance sheet expense? Because balance sheets, I thought balance sheets only had assets, and then on the other side, liabilities and equities. What does that mean exactly? So the thing is that there are some expenses that are put in there that you then are paying down. So like car loan, like if you bought a car through the business, or your bank loan. This is the reason why you can't only look at your profit and loss. Like I'll have people tell me, oh yeah, I know it only costs me X amount of dollars to run my store. And I ask them where they got that information from, and well, that's from my profit and loss. I know that they're not being honest, because you have to know what your balance sheet expenses are. And I don't want you to make that mistake, because this is missed all the time. This is missed all the time. So I want you to look at all of your expenses on your profit and loss, and all of your balance sheet expenses, and divide it by 12 in order to get your average monthly expense. Okay, so then you know what your average monthly expense is. And then the next thing I want you to do is I want you to see if there's any big expenses coming up. So now that you know what your expenses are right now, then put down any other big expenses. Do you need a new computer? Do you need a new point of sale system? So that we can then, we'll take what your expenses are going to be now, and then we can see if we can factor in these other big expenses. Because what I said is, this is what I was talking about when I said, I want you to be able to use these numbers to make better decisions. And that's what you can do. I find that people tend to make decisions just from number decisions, especially just from the seat of their pants. And so tell me this doesn't happen to you, because you have days that you're feeling rich and days that you're feeling poor, right? I am guilty of this also, because if I have extra cash in my pocket, somehow I manage to spend it. Whereas if I don't have extra cash in my pocket, I don't spend it, right? And that's what happens. I find that you'll make a decision to spend something based on what your checking account balance is, rather than your actual numbers. And you cannot afford to ignore your numbers. And this is what I'm giving you all this information for, so you no longer need to do that. Alrighty, so this is an example of those, hold on here, so so sorry guys. Well, these are a couple of things that I want that I would show you that you have to add up. So this is an example of how to add it up on the balance sheet that I had, so where it's marked up. Because the one thing people sometimes miss is that they'll miss the fact that under cost of goods, there can be expenses included there. So in this particular case, you're going to take the freight costs and the packaging costs, those two costs together, and then you're also going to take the total expense, which is $249,780, and then you're going to add in that total other expense also, and then add those 4 highlighted numbers up. Okay? That's what's really important. And then you add those 4 items up to make up the $273,499. Okay. The one other thing I want to point out to you guys is that the one number that should be subtracted. That's right, you heard me. The one number you should ignore if it's on here is depreciation, or a word called amortization. Depreciation and amortization should not be included in this because they are actually a non-cash expense, meaning that it's what the accountants do, and it's in a regular accounting term, so it should be in there. In fact, it's usually wrong if it's not in here. But what it does is that it's a way that the accountant uses of depreciating your assets, your fixed assets. So we usually see it in here, and so you would take that out if that was true. Okay. The other thing that we would add into here are the balance sheet costs, like how much I'm paying back on the bank loan that I have. That's the other expense that would be added in here. Okay, so now there's 2 things we're going to look at here. Again, if you have any questions, you know I'm here. So there's 2 ways that we're going to look at cash flow. The first thing that we're going to do is calculate an annual cash flow, just so you can get a big, broad, general view of how to do this. But I also have to tell you that honestly, I rarely end up doing this because I honestly find it more beneficial to look at it on a monthly basis. But I find that there's people who want to do it this way, so that's why I'm telling you, because I want to make sure that you have as many ways of looking at this as you need to. Okay, so the first thing that you do, and this is all in your action guide as well as in your pages, right? So the first thing, this really gives you the big picture. So the first thing that we do is that we're going to all you have to do is just fill in the blanks. So you fill in what your sales are year to date, and that's what this year's profit and loss is. You can get it from there. You fill in what the projected sales through the year end are, and that's a projection number. Once again, being conservative, remember. And that then covers your sales. The next part is what your trade payables are at the end of last year. So it's how much you owed your vendors at the end of last year. Then you look at how much have you received at cost year to date. Now it's actually not a projection. You should actually be able to get that from your point of sale. How much you've received year to date at cost. I wrote projection because it doesn't come down. It doesn't come from your balance sheet or your profit and loss, because what that shows, the cost of goods that's on that is just the amount of checks that you've written. So that's just literally how much inventory you've paid for this year. So some of the inventory you've paid for this year was included in that trade payables number for last year, right? So this is a little tricky, and that's why I'm trying to make it so I want to make it so clear for you. Again, any questions, I'm here. So take your trade payables from last year that was on your balance sheet, how much you owed your vendors, your accounts payable, with the trade part only, and then add up, according to your point of sale, how much you've received year to date, and then you project what else you're going to receive going forward. That's what you do here, is you project what you receive going forward. And and a good thing, this is where it's a good point to use that information that we shared last time in our last in part 1. For most stores, it shouldn't be more than 42% of what the sales are that you're projecting to do. Okay, so that's the whole inventory part of it. So now what we're going to do is we're going to talk about what our expenses are. So first you're going to look at, from your last year's balance sheet, what your expenses outstanding were, any other outstanding expenses, meaning your those other things we talked about for the cash position. So you're going to look at what your payroll taxes were and what your sales tax was. Those are the other things that were outstanding from the balance sheet. And then you're going to look at your expenses this year to date, including your balance sheet items. And then you're going to look at what your projected expenses are going forward. And also adding your balance sheet items this time too. So you're taking the sales and you're adding those numbers together, and then you're subtracting out all the other numbers. And this is where, so do you want any other capital improvements? Are there anything else you want to do? Do you want a new sign? Do you want to paint? Do you want to add a computer? This is where you can put that number in. And then you have what your total number is. You'll know if your cash flow is positive or negative, right? So this paints a big picture of what your cash flow is for the whole year. All right, now let's dig into how to do it on a monthly basis, shall we? Shall we? Okay, so now to calculate the monthly cash flow, this also is a sheet that you have. Like I said, it's a you have the filled out one that I'm going to show you, as well as a blank one, and as well as on an Excel file. So you have so many samples of all this. And I can't begin to tell you how proud I am of you, because you for sure are in the top 1% of all retailers, because you're doing this, of all independent retailers. You have no idea how much you are increasing your ability to not just survive, but to thrive. Going through these numbers, I get that it's a pain in the butt. I get it. But going through this and sticking with this puts you head and shoulders of everybody else. This is you really taking responsibility for what you've started, what you've created, and turning it around. What I say is that truly having a profitable retail store is a revolutionary act. Because not everybody looks at it that way, do they? And that's why you're here. And that's why I'm so proud of you for sticking with this and watching this many times, however many times you need to get it stuck in your head. Because it will change everything for you. Everything for you. Sending you a big hug. I'm so proud of you. All right, so let's go through this and put some definitions here, shall we? So first, cash position, that very first column where you see that negative 42,260. Remember I told you that shows where you're starting. Okay, so this is where we're starting. The next thing is what your sales are, your revenue is. And again, conservative estimate. Okay, expenses are your operating expenses. That's that average of what you actually pay out every month. So remember I said we have to include all those line items, all those highlighted items on the balance, on the profit and loss, as well as what's on your any balance sheet expenses of what you pay out for either a car or for loans or anything. Alrighty. And then trade payables, that's your inventory cost. And I do this based on net 30 terms. Okay, one last plug, but I'm only giving it to you because the huge difference that this makes in people's lives. Private clients get their inventory, how much they should be spending on inventory a month, given to them every month. That they know exactly what their budget should be. That is priceless. It's your single largest expense, and we control it for you. Okay? Now we can you can use the information from the last module, from part 1, to determine, because it should be about 52% for the whole year for most stores, but not for every store. And you do kind of have to take into account the ebb and flow of sales. But you guys, I can tell you that when you let us help you with this, our average clients see a 16% increase in sales, with almost 20% less business. It's crazy. It's less inventory, less business. 16% increase in sales with 20% less inventory. It's so powerful. So then the word cash flow there gives you what the cash flow is for each month. And then the cum cash flow stands for the cumulative cash flow. All right? And now what I want to do is go over how this adds up, okay? This is how it looks when it's been done out for a whole year. Like I said, you have all the samples of this and all that stuff all done. So let's look at January. So what I like to do is that when I'm predicting things going forward, I make it so that the projections are always end with zeros, and so that the actual is then, so I know the actual when it's an actual versus a projection. So for example, here it certainly appears that the January numbers are actuals. So the January sales were 32,766, and then the expenses averaged out for the whole time were 22,792. And I can tell you that just works out the best always, just to average it out all the way across. Okay, now the trade payables for January, the amount of inventory that was received, that's the amount of inventory received in the month of January, was 15,998. So you're saying to yourself, how the heck is that cash flow a positive 99.74? I'll tell you how. I'm so glad you asked. The reason why is because the cash position, that negative 42,260, includes everything that's owed. Remember the cash position included all of the everything that was owed, like for December, and that's where the December trade payables are. So to determine what the cash flow is for January, we start with what that cash position is, the negative 42. I'm sorry. We start with what the sales are, the 32,766, and we subtract out the 22,792, because just for that first month. And so that's where the positive 99.74. Because just for that first month, the trade payables are already included in the cash flow, the cash position. Gotcha? So you take that negative 42,260 and the December payables. Like I said, this is based on net 30 terms. The December payables are included in there. I don't want you to overthink this. And so so like in some industries, they always get net 60 or whatever. But I tell you, it's just easiest to put it on net 30. And boy, if you are having terms, if you're on COD with everybody, you've got to change that, because that will kill you. A store cannot survive on net 30 terms. Cannot survive on net 30 terms. Alrighty, so the cash flow for the month is a positive 99.74. So what we do is we take the cash position of negative 42,260. We add the cash flow for the month, and we come up with the cumulative cash flow at the end of January of being 32,286. And then we just go forward. So for February, February is a projection month, so it's 32,000 less the 22,792 right here of expenses. Then we subtract out the trade payables from the month before, 15,998, and that brings us to a negative 67.90. So then you add these two numbers, this number to the previous cumulative cash flow, and it's a negative 39,076. And like I said, the Excel formula that you have, the Excel sheet you have, fills all these numbers out automatically. So as you fill in your revenue, and as you fill in your expenses all the way across, and as you fill in your trade payables, and you run the math and all the rest of it, the reason why I like to do this monthly is because of how all I have to do is look at how I started here at a negative 42,260, and how is it that I end up in December? I end up minus 89.96. So listen, honestly, how I would say it, if this was my client, I would say, okay, so we've got to fix this, because I don't want you to end up negative at the end of December. So what can we do to make this a bigger number? And the beauty of it is that we have 11 months to get there, right? So we have 11 months to try and fix it. So what we know of is that if we take this negative 42,260 and we subtract out this number, or actually another way of doing it is if we take what the sales are for, well, anyway, the point is that it tells us what our positive cash flow is for the whole year. And so in this particular case, it's 33,264. To be honest, I like to look at it a couple months going forward, because, we're in this for the long haul, right? And so I like to know what it's going to look like next year then. When I been looking at how my sales are trending and taking all that number, it's really great to see. But listen, this is the other reason why I like to do it this way. why I like to do it monthly is because you can see then, I like to look at and see where my cash flow really, like where it gets bad. And so this is the case where, so right here, oh my goodness, it gets so painful right here. I can see how horrible it is. These couple months here, March through June. So this is where I'm talking about that golden key, because you can have a negative cash flow, but you know it now. And so you can start preparing for it. So, for sure, you're not going to buy any big things in this time period because the cash flow is going to be tight. And in addition, you also have to make sure that you have funds to cover this cash flow, right? So you're at negative 42 here. So you really want to, the worst here is 46. So like I would look at these two numbers here and say, okay, so I've got to have access to about $15,000 in some other way in order to be able to handle that dip in cash flow. So do I have that much open on credit cards? Do I have that much open on my line of credit? Can I get more money from the bank? Or do I have to talk to vendors about it? Do I have to, or what else, what other expenses can I kind of tweak back? But do you see how freeing this is? Because you know it now. This is why there's no emotion. There's nothing attached to this negative 42,260, because all that matters is that you're changing it. That's why I'm so proud of you. That is what is so exciting about it. That's why this is the golden key. Like I said, cash may be king, but the queen has the golden key of cash flow, which is indeed the key to the kingdom. And now you have that golden key. You have it. Congratulations. You know what it looks like. And the best thing about it is that you can take action. You can see when do you have to have extra cash set aside in order to be able to handle that dip in cash. And so, listen, I talked to you about about how to cover it, but listen, the other aspect of it is what can you do to increase sales those months? I just did that with a client just last week, where we saw that 2 months from now they're going to have a big dip because of something else that came up, and so we're now working through what is she going to do to make sure that she can handle that. Right? Can you spend less those months? Can you maybe move some inventory around? This is where you have to be able to control, and we'll talk more about this later, but this is where you have to be able to control your flow of inventory. I want you to use your golden key to open the door to a kingdom of peace and fun and better sleep. All right. Hey, and when to do this? You have got to do this every single month. You have to update it every single month. Hey, if you have the key to the kingdom, why wouldn't you use it? Right? Why wouldn't you use it? And yet, I see people screw this up. That's not going to happen to you. Set your appointment date right now of when you're going to review, when you're going to step outside of your business and work on your business. Not in it, but on it. You've been given the golden key. Use it. And it's crucial that you remember that budgeting is not a 4-letter word. So going back and referring to what we talked about in part 1 with all those percentages of everything, you have to use that as a budget. A budget is a spending plan. That's what it is. Make one and use it. When you make that appointment with yourself, go back and review. Make sure that all your percentages are in line. That's all I have to say. You have to take responsibility for this. There's no one else that can. It's you. So step up to the plate and make it work. You deserve to do it for yourself, and your community deserves it. What you provide to them is so important, and it makes such a difference in their lives. I know that they don't always tell you, but it makes such a difference in their lives, and I want you to be there for them, and I want you to be able to bring more money home. So make a budget and use it, and review these numbers. Make an appointment with yourself every month to do it. Get your percentages in line and pay attention to it. All right? Okay, all right. Hip, hip, hooray. Now, I'm going to give you a quick accountant test. You see, what I find is that I just had so many clients ask me, so, I talked to Don and I talked to John, and they both seem perfectly good accountants. So, how do I decide which is best? And so what I tell clients to do is really it all comes down to what is your tolerance for risk? All accountants are required, and to follow the law, and I'm sure that everyone you're talking to is doing that. So they're all required to follow the law. But how risky do you want to be? That's really what it all comes down to. So what I recommend that you do is you ask your accountant about how they would recommend you handle a car expense because this is an easy way of taking care of it. Because there's two perfectly legal ways of doing it. Two perfectly legal ways. The first way is more conservative, that you pay for all your car expenses through the year, and at the end of the year, when you do your taxes, you've kept track of all the miles you've gone, and the store paid you back for all the miles at the end of the year. So that's the more conservative way. The less conservative way, the more risky way, is that the store covers all the expenses, and then at the end of the year, you claim the miles that you drove for personal use as compensation, meaning that that's how the store is paying you. You know, there's a certain amount, and the government changes it every month. There's a certain amount per mile that you can claim. And so either for the more conservative way, the store pays you back for all the miles that you drove for the store. The less conservative way is that the store covers everything up front, and then you claim the miles that you drove as that's how one of the ways the store paid you, and then you might have to pay taxes on that, right? Or I mean, you would imagine. Well, whatever. Anyway, it adds to your income. So you can see that there's a big difference here in cash flow, right? I mean, in personal cash flow or store cash flow. But that's the point, is that that's a really easy way of doing it. Again, I'm not an accountant, but I've used this question so many times just to help determine a client's comfort level with an accountant. Like I said, it's just simply a guideline. Albert Einstein, my favorite quote, doing the same thing over and over, but expecting different results is the definition of insanity. And yet, how many times do we all do this? Things are going to be different this year. Things are for sure going to be different. And then you come up with 100 reasons why it's not. Well, let me tell you, you have committed to the first reason. You've learned all this stuff. I'm so proud of you. You've learned all this knowledge. And so then the second key is a plan of action. Do you have one? Do you have that golden key? Do you? You now officially have access to the golden key of cash flow. You now officially can understand and have less stress about cash flow because you understand how to manage your store's finances better. Again, any questions you have, you just go ahead and ask. Either on our community call, write them down now in your worksheet, in your action guide, as well as, and then you can ask them in our call. Thanks so very much. I know this isn't easy, but it's necessary. And you can do it. Happy retailing. Talk to you soon.